To talk to us about exactly what is happening with Naspers and Tencent, we are joined by Gary Booysen, who is from Rand Swiss. Gary, thank you so much for your time. I mean, it doesn't quite surprise me. I almost feel like it's like sort of a Groundhog Day. Every couple of weeks, you look at Naspers or Tencent, either one of them falling either on Chinese fear, tech regulations, or some other issue. Your initial thoughts when you saw the Naspers, Tencent and Prosus share price?
Well, I think it's always disappointing to see a share price that composes such a large portion of certainly the South African exchange, but also so many retail investor pensions down as much as it is. So it's always a little bit shocking when you see it, especially given the incredible performance that it's delivered, let's say, over the last 20 years. But as you said, there's just so many moving parts to the story. On the one hand, you've got obviously reports surfacing around regulatory changes and a potential antitrust fine. They haven't yet put the quantum on the antitrust fine, but they're talking about a fine in terms of record levels because Tencent, through its WeChat Pay, has essentially contributed to know your clients, the KYC regulations in China. That's kind of casting a pall over the stock, but at the same time, the stock's actually performing only down 13%. If you compare it to some of the other Chinese tech companies, Baidu, for example, down 17% today. Now, that's not got anything to do with the specific stories around Tencent. It's got to do potentially with two aspects. The one is the idea that 17.5 million people went into lockdown in Shenzhen and the rise in COVID cases in China. China's obviously followed a much more stringent lockdown policy than the rest of the world, and you get the sense that the immunity levels are not as high in China, and this could be a persistent issue. On the back of that announcement, we saw the likes of Foxconn having to shut down factories as well. Foxconn obviously making Apple phones, so disruptions to the supply chains are going to be real. But I think the other thing that really has spooked markets around the tech sector in China is the idea that Russia has reached out to China for military aid. And if we see a bifurcation, so a division of the world powers and a new global order almost arising after the Ukraine-Russian conflict, and China is backing someone like Russia, and we see that more like that backing more overtly coming to the fore, I think that's going to have incredible ramifications for investing in China in general. And so many of these Chinese stocks are listed via the American Depository Receipts Program, so ADRs in New York. And already there's real concerns that these types of investments won't be accessible if we were to see, let's say, heavy sanctions on China somewhere down the line. And while that seems like a very outside prospect at the moment, it's certainly rattling around in the back of investors' minds, and I think that's just yet another sort of angle that could potentially be putting pressure on the share price.
So, which then, brings a conversation that people have been having, at least for the past couple of months, though, that value versus growth move. I mean, is that something you expecting to continue, or is it a case right now where you just buy the dip?
Well, I think buying the dip at this stage is pretty hair-raising, which is generally the best time to be buying dips. But if you look at value versus growth shifts over let's say the last 50, 60 years, they tend to be fairly long-term movements in markets. So what happens is, you're talking about 5 to 7 years. So maybe a little bit early to be buying the dip, especially if we do see exacerbated inflation numbers and just that rising price level everywhere. Because once inflation creeps into the system, it's very, very difficult to get it out of the system. And what we're seeing, certainly from the US prints, and I think what we're going to start feeling in South Africa fairly shortly as well, as prices start to rise because of supply disruptions and so many other things, that this is a fundamental change to the playing field. When the cost of money, which is interest rates, start rising, the game really changes, and it is a long-term trend. So I think buying the dip on the tech-heavy stocks at this stage is maybe a little bit premature, and certainly investors should be looking at a value slant to portfolios at least for the next couple of years.
We have central bank meetings this week. What will you be watching out for?
So we've got a whole raft of central bank announcements. So I think out of the G20, eight countries will have their central banks reporting this week. But I think the one it's got everyone's attention is going to be what happens in the Federal Open Market Committee meeting on Wednesday. That's expected. I think the expectations are for around a 25 basis point hike, so 0.25% at least. And that really is going to be key to, I think, so many other central bank decisions, but all of them are going to be interesting, I think, specifically with their commentary around how, one, supply chain disruptions, but also the Russia-Ukraine war is going to affect the economies and their forecasts.
All right, Gary, let's leave it there. Thank you so much for your time. That is Gary Booysen from Rand Swiss, taking us through the latest market developments. And we didn't get a chance to touch on some of the company results from this morning. However, we will be playing that ABSA interview that I did with the Chief Financial Officer, Punki Modise, talking to us about how that particular company performed. But let's take a quick break. When we come back, we'll have Africa Trade Brief.